Welcome to our High Rock monthly video. I'm Scott Tomlinson, and with me today is my colleague and partner and the founder of High Rock, Paul Tepsich, as well as High Rock certified financial planning professional Bianca Tomlinson. We all know that our clients are almost all long-term in their thinking, the greatest number, most focused on their wealth forecast goals, and almost all of the remaining focused on long-term returns. We know that we have to take risks to get returns that will beat inflation, but we want to take smart risk that is consistent with each of our long-term objectives for our money. Well, as you know, our mandate to you is to invest our portfolios in a manner in which we would invest for ourselves, owning the exact same assets, albeit in potentially differing proportions relative to our own long-term goals. We know that if we focus on earning income from dividends and interest, that we can reduce the dependency of a portfolio to earn higher risk capital gains. Paul, have we made any significant moves in our portfolios through the course of November and early December?
Yeah, we have. We did make a couple changes. We actually added a equity position in the tactical model, Canadian Energy Services, and it's not an exploration and production company. It's actually a company that manufactures chemicals that go into drilling pipes for the exploration and production companies. And this company I know pretty well. I've followed it for a lot of years, and I wasn't a big fan of it, but I'll tell you, they've really turned the corner, and they're starting to produce very consistent cash flow, and that cash flow is 80% of it is now going towards debt reduction, and they've actually started paying down bank debt, which is significant in itself. They are doing maintenance capex, and then they're actually still paying out a very small dividend. We own this bond not in our private client tactical position, but some of our high yield clients own it. But in our tactical position for our private clients, we do own this stock now, and I kind of like it. But again, we're taking a very measured risk, given it is in the energy space in Canada. So that was one new position, and I find it pretty interesting. And then in general, well, maybe a little bit last week, but we'll have some this week, settling today and next week. We've got some high yield bonds that are going in the fixed income model and some in the tactical model. We were able to get some bonds at the mid-market pricing level from another mandate that we have. So that will be somewhat impactful, and that will increase our total portfolio cash yield when those trades settle by the end of next week. That's about it, Scott, and we should largely be, I think, finish most of our portfolio adjustments for the year.
Tremendous. Great. Thanks for that update. Let's just recap a little bit. So global stock markets in November were up a little under 2.5%. Bonds in Canada, for the most part, were unchanged. So the index was unchanged, and the index ETF, very little change. So really, client portfolios, depending again on your composition and structure, probably up somewhere in the vicinity of over the course of November, 0.75% to maybe 1.25%. Again, depending on your specific situations, and of course that's to a large degree based on your wealth forecast. But it was a pretty good month, and we're happy to see it. But of course, as we say, we're always focused more on the long term. So, Paul, what's keeping us up at night these days?
Well, there's one chart, and we've written blogs on it over the past, both you and I, over the past couple weeks. But I have a hard time reconciling the fact that this chart says it all, that the S&P 500 stock index in white is going up, and it looks like it's near the top of a channel from a technical perspective. But fundamentally here, we've got U.S. gross domestic product, or GDP growth, which has decelerated from the beginning of the year, where it was around 2.7% to now around the 2.1%. and arguably being guided lower. So there's, as you can see there, quite a gap opening up between the stock market and the fundamental reality of the economic picture, and something we just have a very hard time reconciling and buying into.
Well, especially when historically the trend of better GDP growth has been driving and leading the stock market, which if that continues, obviously that doesn't bode particularly well for the stock market. And just to take that a step further, GDP as we see it announced ultimately is a bit of a lag, has a bit of a lag time. But when we look at leading indicators like business confidence, we see that that is obviously something that is now, I guess, a function of the geopolitical circumstances, trade, of course, at the top of most people's radar screens, and whether or not a deal with China will come, whether or not a deal with China will have a primary deal with China will have enough of an impact. And then there's all the potential issues that are raised with the U.S. Trade with Europe and even with Canada for that matter. So keeping an eye on leading indicators, of course, is something that we want to always be doing, and it's important that we do so. Interestingly enough, as far as lagging indicators are concerned, today we got the latest results from the monthly employment report in the United States. It was up significantly. There's some technical factors with the GM strike that come into play. And as you can see, it's an erratic monthly number, although a lot of traders do trade off of it. We tend to want to look at that pink line, which is the moving average, the 12-month moving average. And you can see that through 2019, that average has actually moved lower. And that, Paul, just is a function of slower economic growth, as you were pointing out before. So these are the things that we watch, we worry about, and continue to be cautious as we look going forward. And of course, all of these things come into play when analysts start to look to the future for earnings and earnings for the fourth quarter of 2019, which we're in right now, and the first quarter of next year have all been revised lower. And again, fundamentally, as Paul was saying, this can't necessarily be good for the stock market because it makes stocks look even more expensive. Well, in Canada, we saw Canadian business confidence bounce back in the last month. And although, again, once it is somewhat erratic, but the trend has been from the recent trend, upper left to the lower right. And that obviously is leading Canadian economic growth. And again, we also saw today's Canadian employment data, and once again, these numbers from month to month can be very erratic, but it was a pretty significant move down in Canadian employment growth over the course of November, and it has turned that pink line back down again. So obviously, we got to keep an eye on what's going on here in the Canadian economy. Certainly, we saw the Bank of Canada come out and be somewhat more positive when they made their interest rate announcement that there was no change. But again, they did outline the risks that were pretty much the trade situation, the global trade situation, and the global economy that were creating lots of uncertainty. Paul, any comments?
No, but as you said, yesterday alone, Deputy Governor Lane made some comments again about how Canadian monetary policy at the Bank of Canada can diverge from U.S. monetary policy at the Federal Reserve. And our government bond yields went up, pretty significantly at one point, about 7 or 8 basis points, independent of the U.S. From my lens and where I sit and companies that I look at and follow from a fundamental perspective, I can tell you two things. Yesterday, CIBC reported their results, as did TD Bank, and both banks increased their provisions for credit losses, or PCLs. much more than all the equity analysts were expecting. And that is a sign of, potentially, a sign of things to come in the Canadian economy. And I personally think these banks are ill-prepared, especially in the energy space. And I think the Bank of Canada is ill-prepared right now. So I mean, from the companies that I look at, there's some serious weakness going on right now. And I think the bank is a little bit behind the curve.
Great, thank you.
I.e., I should say behind the curve that they may have to start thinking more about the economy weakening, and they may need to think about cutting rates.
Great, thank you for that. On a global scale, it is thought that the global economy is actually starting to stabilize a little bit. I know it's been heading lower as well. However, we continue to watch the OECD leading indicator, and it continues to move to levels that we haven't seen since 2009, 2010. So probably another thing that we're want to monitor very closely on a global scale, and certainly, of course, to see if whether or not the trade situation is going to become better or worse. Well, what excites us these days? Certainly, we, as most of you know, we did a survey back at the end of October. We still have a few clients adding to the responses, which is great, and we appreciate all of it. The one thing that we want to hold ourselves out as is providing better than average service, and 86% of our clients believe that we do. There are a few, the 14% or so, that think it's only average, and that obviously means we need to take that into account, and there are some improvements that obviously need to be made. And we look at the comments that we got. We know we're not perfect, and we really do appreciate the written feedback as well, because it gives us some ideas of perhaps where we need to improve upon. And we always want to be improving. And I encourage all of our clients, anybody who's got anything in particular that they would like to talk to us about, to please feel free to get in touch with us independently or individually. Let us know what your issues are, because we certainly are always open and want to be providing the best possible service to everybody. And certainly the first, if you'll look here, comment is that from time to time, things may not be getting done, and that hasn't been a good experience. So one suggestion that I do have is that when you do contact us, if it is a service related issue, certainly put your email Bianca or call Bianca. But if you want to copy me and or Paul, just to make sure that if Bianca's really busy with a bunch of things, that she doesn't miss it, just by copying us, that means that we'll be able to address it as well, and make sure that it's looked after. Or if you're trying to get a hold of me, copy Bianca, copy Paul, just to make sure that we're all backing each other up. So we don't have these kind of situations where something that should be getting done on a timely basis isn't getting done. Of course, people are happy with our service, and we love those comments as well. But again, there are things that people are asking. Some people would like to see things differently on their quarterly reports, perhaps, and we're wide open for suggestions. We have a lot of data that we're able to provide. So if there's something that you do want to see on your report, we do get feedback from that. We want to make sure that you're seeing what your performance is like, and the performance that we send you is always net of fees. But we do send out a fee statement on an annual basis. That is regulatory requirement. So that's something that we want to be able to provide for you as well. And again, we all participate in the exact same assets as Paul, Bianca, and myself do in from a portfolio standpoint. And we try on the monthly call to update you as best as we possibly can. We will continue to provide as much feedback on that as we possibly can. And of course, finally, if you don't want paper reports, all the information is online, and it is a function of just ticking a box to make sure that that you don't get those paper reports. But if you need help with your online reporting, please get in touch with us, and we're more than always available to walk you through your Raymond James online portfolio services. And as for the pizza, well, anytime you want to come visit, we're happy to order in some pizza. All right, well, that's it for our 2019 monthly videos. I can't believe the year is coming to a close so quickly, but as always, we're thrilled that you have taken the time to tune in. We shall be back with our next installment at the beginning of January, and it'll be our first for 2020 and a new decade. But on behalf of Bianca, Paul, and myself, I want to wish you all the very best for the holiday season and a happy, healthy, and prosperous new year in 2020.